everyone. Welcome to the Biden Tax Series. I'm John Van Duzer, CPA and partner, and I'm joined by Daniel Rocani and Elena Davis, where every Thursday we'll present the latest updates regarding the pending tax legislation and how you can stay informed and see how it will affect you. Daniel, Elena, thank you for joining us.
Happy to be
Thanks,
here,
John.
John.
Real excited to be kicking this series off, and we're going to dive into the history of the tax legislation and then continue to update everybody as things progress. So wanted to give a quick update on where we're at today, and kind of give a history of how we got to where we're at. So on May 28th, the Biden administration released its annual general explanations of its budget proposals, and this is commonly called the Green Book. So in that, they basically outlined, here's the things that we would like to happen. However, the administration isn't unilaterally allowed to change tax laws, so it has to go to Congress. And so that's kind of the next step in that process. On August 2nd, the Senate released its bipartisan infrastructure bill, which basically laid out what their vision of the pending tax changes were going to be. And then September 13th, so a week ago, the House Ways and Means Committee, they released their version of the infrastructure bill, which includes the tax proposals. So now we have working tax proposals both in the Senate and the House. So looking forward, they all have to pass one bill, which means they have to agree. And a lot of people speculate that that's going to be in the November, December timeframe, but there's going to be a lot of horse trading and jockeying until that time. So this is definitely something that we're going to be following day by day, just to make sure that we can plan for whatever that eventually is going to come. So what I thought we could do today is kind of run through the House bill and talk through some of the high level points. In subsequent weeks, we'll continue to update based on changes, and then also take a deeper dive into some of these areas and really explain how they could be of significance to you as you plan, what your taxes look like for you in 2021 and in 2022 and going forward. So, Daniel, why don't we start with you, and why don't you tell us about some of the changes? One of the high level priorities was increasing the tax rate. So tell us what changed with the tax rate.
So when President Biden first talked about this plan, he said, "I'm not going to raise taxes on anyone making under 400,000." So this is a theme you're going to see throughout this entire bill. So when it comes to tax increases here, the first one that comes up is the corporate tax rate. So Trump slashed it down to a 21% flat tax. This will bring back the tax brackets. So anyone making 400,000 or less will actually be only taxed at 18%. Then up to 5 million will be at the 21%. So anyone over 5 million will now be taxed at a top tax bracket of 26.5%. And if you make over 10 million, then you will actually get rid of all the tax brackets and you'll be taxed at 26.5% total.
Right. And that's for C corporations.
Exactly, only for C corps. For the individuals, which most of us all have to pay, the tax top bracket went back up to 39.6%, which it did before the Tax Jobs and Cuts Act. This again will not be taxed at anyone for anyone making 400,000 or more single, or 450,000 or more married and filing joint. And then there's this 3% surcharge, and this is an extra tax on anyone making $5 million or more.
Right. So that's an ultra high wealth or high income. You have an additional, let's just tack on another 3% as a surtax on top of that. So the interesting thing about the bill, though, is just besides the rates, there's also other tweaks that they can do in the calculation of taxes that increase the taxes as well. So why don't you tell us about some of those other tax calculations?
One that I've been around for a little while now is the net investment income tax. This came out in the Obamacare to help pay for the Affordable Health Care Act. So this one, they're going to expand it a little bit more, and for high earned incomes, this is 400,000 again if you're single, 500,000 if you're married filing jointly. They're going to cover net investment derived in the ordinary course of a trade or business. So this would be something interesting to dive down into more, but it's usually just for passive income. So high income people could be having to deal with ordinary income. Also, the QBI, the Qualified Business Income 20% deduction, that's helped out a lot of small businesses. They are going to cap that deduction now. So the max allowable deduction is $500,000 if you're married filing jointly, and $500,000 and $400,000 if you're single. So that will now come with a cap for anyone getting a very large deduction there. And then they're also going to reinstate the excess business loss limitation. So this is just any excess losses are going to be disallowed, but the losses will still be carried forward in the future.
Right. So that's going to take, and you're already paying taxes at a higher rate, and they're basically adding additional taxes on top of that and cutting deductions. So you're going to be, driving everybody to paying, higher overall effective rate. Another big hot topic was changes to some of the rules around capital gains. So walk us through what's changing in the world of capital gains.
So yes, capital gains has been a hot topic, especially since they're taxed at a lower rate if you hold them long term, at least 1 year. The tax top bracket used to be 20% for capital gains. That is going to increase to 25%, and this is going to become effective the date of the introduction of this bill. So that means that this 25% will be basically effective September, about right now.
Right. And that's actually a break with the Biden administration where they wanted the top capital gains rate to be 40%. So it's interesting where in the House now they're at 25. The Senate, I believe, is higher than that, and then the president wanted 40. So it's interesting to see how things have evolved.
Yes, they wanted to be ordinary tax rate to 39.6%. Another one that is in this bill that's been talked about for a long time is carried interest. So right now, you have to hold carried interest at least 3 years to be taxed at capital gains rates. They're going to change that to 5 years, but only for high earned income people, and that's people basically making 400,000 or more.
Yeah.
And then another one is the 1202 stock exclusion. So this is qualified small business stocks. So right now, when you can get that up excluded up to 100%, this is going to be go down to 50% now, again, for high income earners of 400,000 or more.
And tell us about the last one with crypto, which is one of my new favorite topics.
Right, crypto is huge right now. So this one we kind of knew was coming, but basically they are now making cryptocurrency have to apply to the wash sale rules, which in short basically means if you sell crypto at a loss and then repurchases within 30 days, you cannot claim that initial loss.
Right. So this is another theme that I kind of found in the House bill is there's been a couple topics that have hit the news as kind of a loophole or something sensational, and you see legislation directly addressing that. So right now, if you have big losses on Bitcoin, you can sell it, you can buy it right back, you can take that loss in full. If you have a stock from the stock exchange, like a publicly traded company, you did the exact same thing, that loss is going to be disallowed. So there's an incongruency in the rules there. So they're tightening up that loophole. Um, and we'll continue to dive deeper in capital gains because there's a lot in that and a lot of implications. But another big area was retirement plans. So Elena, why don't you walk us through kind of some of the changes coming in the world of retirement plans?
Yes, there are several changes surrounding retirement plans, and a lot of them will affect, like Daniel said, those individuals with taxable income levels of over $400,000. So one of the biggest things that they're trying to push is to disallow contributions to IRA accounts or any kind of retirement plans once the value of that plan reaches $10 million. That
Mm-hmm.
has never happened in the past. You could contribute regardless of the value in your account. Another interesting thing is that once that value reaches and exceeds $10 million, then you are going to be required to take additional distributions from your IRA accounts, including Roth IRA. And the calculation that they're trying to require is that anything over $10 million, you will have to take the 50% of the excess out of that account. Um, Furthermore, if you're one of the fortunate individuals who has accumulated over the years retirement accounts at over $20 million value, then you have to take even more of those distributions out. The calculation is a little bit complicated, and basically you will have to take the 100% of the excess over $20 million, or if your value of all your Roth IRA or Roth defined contribution plans is less than that excess, then you'll have to take that out as distributions and pay all the subsequent taxes. Another main thing with the retirement plan is that so-called backdoor Roth IRA is going to close. Historically, you are limited to contribute to Roth IRA accounts if your income levels exceed certain threshold. Well, the walk around that was to contribute to non-deductible IRAs and convert that account into Roth. Well, that's what's going away. Furthermore, uh, you will be limited on what kind of assets your IRA account can even invest in. And basically, the idea here is to further prevent any kind of self-dealing, to where if you're an owner of a business and you also have an IRA account, you basically will not be able to contribute to your own business through that IRA portfolio if you are more than 10% business owner or even an officer. Currently, that limitation applies to anybody who owns 50% or more of their business.
Right. So again, Congress sees some high-profile cases where people accumulated really, really, really large balances in their IRAs, through self-directed closed company investments, and so they're closing that loophole on a go-forward basis. So that has huge implications, especially if you use a self-directed IRA. Another area, probably the biggest area, the area I think we've heard the most about is estate taxes and the changes to estate taxes. Elena, why don't you tell us what we can look for in changes for estate taxes?
Yes, John. So the biggest estate change that is on the table for discussion now is the reduction of unified credit that is currently set at about $11.7 million. And the proposal is to revert that credit that you are able to take against the state and gift tax back to $5 million, which was about 2010 levels. Um, Another interesting thing that is on their agenda is to close the loophole that is available to the grantor trust. And basically, if you're a grantor and have a grantor trust that you transfer your assets to that trust, you will not be able to exclude those assets from your taxable estate once you die. Um, Certain sales of property between a grantor and the grantor trust that a grantor has will be treated as if those were the sales between third parties, therefore fully taxable. And when it comes to certain valuations for non-business assets that are held in LLCs, limited family partnerships, other private entities, they were able to be valued at like a discounted rate. That will no longer be the case. It will be basically any kind of non-business assets held in those type of entities will be valued at full fair market value. Um,
Right. So this is definitely an area that will warrant a deeper dive because they're really targeting the defective trusts, the slats, the ability to transfer or freeze estate through some of the estate planning techniques that are out there today. They're basically targeting it. So it's going to definitely warrant what do we do going forward. I think the other thing that's important is there is a grandfathering rule for trusts that are already currently in place.
that is correct.
So yeah, so that's really important because at least it's not going to be retroactive, so to speak. It's going to be really on a go-forward basis. The other interesting thing about the estate taxes is what was not on the legislation, which was it did not have any removal of the step up to fair market value at death. So that actually stayed in the House version of the bill. So we'll kind of track and see what happens with that. Um, they're also, without being able to really group it together other than a category of other, there's a handful of other provisions that I think are pretty significant. So Elena, why don't you walk us through maybe a handful of those other provisions?
So yes, one of the biggest thing is the additional funding for the IRS itself, and we're talking about the appropriating close to $80 billion towards IRS being able to enhance their tax enforcement and modernizing informational technology. As we all know, IRS has been struggling, especially this past year, with just responding to all sorts of taxpayers' notices and things like that. So that's hopefully will alleviate some of the struggles from the IRS. There are limits on the ability of certain pass-through entities to take advantage of charitable contribution deductions as it relates to qualified conservation easement properties. So that potentially could go away. There is an interesting proposal that will allow certain qualified S corporations to be able to reorganize and become partnerships on a tax-free basis. So that's something we'll have to closely watch. And then there are a number of provisions that will affect different tax credits. For example, the paid family and medical leave tax credit will be going away sooner than originally planned. It was set to expire in 2025, and now it potentially is going to expire 2-3 years sooner. The so-called tip credit that was available to owners of restaurants and other food industries to take credit against wages paid, Social Security taxes paid on tips. Well, that kind of credit will be available to beauty salon owners. That was interesting. And then there are enhancements to work opportunity tax credit, which is the tax credit that certain employers who hire individuals from targeted groups could take advantage for. So there will be expansion to that potentially.
Yeah, so you can see them focusing on the current labor shortage through expanding, the ability of employers to pay for employees. So that's a really interesting way to address it. So that's all the time we have for this week, but be sure to join us next Thursday for another update. We'll go ahead and cover any new legislative updates that happen this week, and we'll also take a deeper dive into some of these topics. Hope you can make it. Thanks.
Thank you.